Welcome to another video with Invest with the Doctor. My name is Dr. Haider, and I do research myself, look into stocks and places to park cash. And I make these videos so that I can share my research with you. In this video, I'm going to be talking about Vanek Oil Services again and a company called Total Energies. Now, the reason I'm going to be talking about oil once again is I think this is a good time to get into oil stocks. And I'm going to be later talking about the reason why I think oil stocks are a good place to be. So let me first show you an article by Fortune. Um, you can look at the article itself on fortune.com, and this article is from the 14th of February 2026. The article is headlined as a US debt spiral could start soon as the interest rates on government borrowing is poised to exceed economic growth, budget watchdog says. Now, you can look at the article, but I've highlighted just a few things which are important to understand. So, they're saying, according to the latest projections from the Congressional Budget Office, publicly held debt is currently at 31 trillion and is about 100% of GDP. By fiscal year 2030, debt is expected to exceed the 106% record set after World War II, then surge to 120% by 2036. Now, this is not me saying this. This is fortune.com article which is saying this. So just try to understand what this means. Fueling that accumulation are annual debt interest costs, which will more than double from today's levels to 2.1 trillion by 2036, taking up a greater share of federal spending and further accelerating budget deficits. Now, they go on to say CBO's latest baseline shows an unsustainable fiscal outlook with debt approaching record levels, deficits remaining elevated at more than twice reasonable target, and interest costs exploding. The Committee for Reasonable Federal Budget said in a note on Wednesday. Later in the decade, under CBO's baseline, the average interest rates on all federal debt will exceed nominal economic growth, which could represent the start of a debt spiral. But the threat of interest costs growing faster than the economy risks sending debt into escape velocity and forcing more drastic measures to prevent a crisis. So, again, I'm not saying this. This is an article that I saw on fortune.com, and I think it's very important. Um, and this is why we need to look into what's going on in the economy and what we should be doing about this. So this is actually my article, my video today, and I'm just talking about this and debating it out in the open, so you can look at it as well. And it would be interesting to see what you feel about this. So, what is a debt spiral? I mean, what does it actually mean? So, a debt spiral happens when the interest rate on government debt R is greater than economic growth G. When that flips, debt grows faster than the economy itself, even if the deficits are small. Economists consider this a dangerous threshold because stabilizing debt then requires huge spending cuts or tax increases. According to budget watchdog projections cited in the article, US borrowing costs are expected to rise 3.9% over the next decade. Nominal GDP growth is expected to slow toward approximately 3.8 or below. That crossover could happen later this decade. So, R which is the common debt, is going to be greater than economic growth. Debt mathematically compounds faster than the economy can grow out of it. So why is this suddenly a bigger issue? Well, there are several structural forces converging. Debt already very high. It's 38 uh, trillion plus federal debt currently. Interest costs are exploding. US is already paying around 1 trillion per year in interest. Persistent large deficits around 1.8 to 1.9 trillion per year projected near term. Higher interest rate environment. Now, post 2022, rate hikes permanently raised treasury yields compared to 2010s. This combination didn't exist before. Historically, the US benefited from low rates and strong growth, which is not what's happening at the moment. Now, what does this mean? Does this mean a crisis is imminent? No, not necessarily. The US still has major advantages. Dollars is the global reserve currency. Especially if you go abroad anywhere, you will see the dollar strength currently. People want dollars. It's got deep treasury markets with massive demand. Federal Reserve backstop is there. They're always there to buy the bonds. sorry. Ability to inflate away debt over time. And if they just leave it be, those dollars are not going to be worth as much as decades pass by. Many economists think crisis would be gradual, not sudden, but the risk is rising, especially if markets lose confidence. So nothing is going to change overnight, but with time, gradually, you will sort of start to notice that things are just not right. And I think people are already noticing this, especially here in the UK. So the real bottom line is that the warning isn't that collapse is tomorrow. It's that the US fiscal trajectory is moving more from something that was manageable to something that is structurally unstable. And once which is the debt, grows bigger than the growth, fixing it becomes politically very difficult and painful. When a debt spiral risk starts appearing, interest costs increase, and they're more than the growth. Markets don't all react the same way at once. There is usually a sequence, and understanding that the sequence is where the edge is. So this is what you need to understand. Rising yields and volatility is the early warning. This is usually the first signal. Government borrowing increases, which increases bond investors' demands, demanding higher yields, which increases the interest costs. Now, bond markets. What happens is there are market effects. Prices fall, yields rise, stocks volatility increases. Okay, so they're going up and down like a seesaw. Growth stocks struggle, and you would have, if you got a lot of growth stocks in your portfolio, you would have already noticed this. And the financial conditions tighten. This phase can last years, and to some extent, I would say this is already happening right now, and you can see it very easily in your portfolio. There's sort of sudden price changes, big price changes, big swings that used to not happen very, very quickly. Now, fiscal dominance narrative appears um, when investors start worrying governments will print money or inflate debt away. This is when real assets begin outperforming. So, when this is happening, which is arguably what's happening right now, you would want to know where are the winners? Where is it that I should be in putting in my money? So, gold, silver, commodities, energy stocks, mining stocks and inflation linked assets are the places to be. And the lagging would be long duration tech, bonds, consumer discretionary, real estate sensitive to rates. This is typically where commodity bull markets begin. Now, there are going to be policy interventions by the government, the US government, and they'll have QE, yield curve control, higher inflation tolerance. They'll have lots of tax increases and spending cuts. If you live anywhere in the UK, you would have noticed what these tax increases are. Every day you hear of different types of taxes being increased and spending cuts. Well, if you're living in the UK, you're suffering from those spending cuts because the government just doesn't have the budget for anything anymore. The most important insight: markets don't crash immediately. Instead, you'll see real assets outperformance and financial asset underperformance. And that's the key itself in my eye. Like I said, the US has unique advantages. It's got a reserve currency, deep capital markets, military and geopolitical power, Federal Reserve flexibility. So the process is likely to be slow and uneven, not catastrophic overnight. So nothing is happening overnight, but it is eventually happening. Now, again, in US, it will happen. It will take time. But in other places, like UK, like Europe, is going to happen a lot faster. Um, Already mentioned the places that you should be in: gold, energy, commodity, mining stocks, infrastructure or real assets, value stocks over growth stocks, and foreign markets might do better than domestic or UK or American markets, or the US markets as they're called. So, this is what I think. This is why my videos have just been about these assets more than anything else. This is why I think gold is going to do well. This is why I think oil is doing well. This is why I think a lot of the other commodities are going to do well. And I'm going to be doing future videos. So if you got cash on the sidelines, if you got money to invest, these places would be nice places to put your money in. Now, having given you such a long uh, discussion on this stock itself, I wanted to mention that the topics for this video, um, and I really hope that this makes more sense for you and for you to understand why it's really important um, that we get into these stocks. So let's go back to what this video is going to be about, which was the oil and oil stocks that I was talking about. Now, in my previous video, I mentioned a few companies: Chevron, ExxonMobil, Shell, Bolero. And in this one, I'm mainly talking about the oil and a company called Total Energies. Let's look at the stock for the let's look at the chart for oil. Now, this is the oil on the weekly chart itself. So as you can see, oil in US dollars. If you can see, this is the weekly chart for oil itself. And once you can see the trend line here. Once it breaks out here, out of this trend line, the price is likely to go much higher, and that's not happened yet. So this is why I feel this is a good time to be in oil and oil stocks. So like I said, weekly chart, it's it's going on sort of touching this trend a number of times, and the moment it breaks here is the moment that oil is going to go a lot higher. Now this is Vanek Oil Services. I mentioned it before in my previous video. OIH is the ticker for it. This is Vanek Oil Services, and again it's touched here, and now it's breaking out of this area here, and my price target for this is 509 US dollars, which is quite far away from the current price of 381 US dollars. But ultimately, like I showed you in my previous chart with the price of oil, once that triangle breaks, it's quite likely that this would be a very achievable price, even though it's quite far away from the current price itself. And the last one is the stock here, which is called Total Energies. It's a French company. Ticker for it is TTE. The price of the stock at the time of making this video is hovering around 76 US dollars, and I think it can, once oil breaks out, quite easily reach 89 US dollars. This is the weekly chart itself. Um, Normally I show you weekly charts because weekly charts sort of align very well with what is happening with the stock itself, and are quite aligned to the fundamentals of the company itself. But once oil breaks out or is breaking out, these companies that I've mentioned are going to be doing very well. So this is what I had to say for the Vanek Oil Services ETF and Total Energies. I hope you found this video useful. Please like and subscribe, and as always, thanks for watching.